Range versus trend. In this video, gonna go in depth on trading a ranging market versus trading a trending market. So if you're a trader, you want to make more money, I promise you there's going to be a lot of alpha, there's going to be a lot of insight in this that is going to help you make more money, win more trades by identifying what sort of a market environment that we're in. So tap in with me, watch to the end, or if you like, put it on your audio and listen as you do other things, because while I'm going to be illustrating on this whiteboard, it's not going to be necessary to for your learning. I'll do as much as I can by talking as well. So the market, in my opinion, typically only really has two modes, which we're going to define. We're going to define the psychology, the fundamental of what these trends are. We're going to define how you have to have different habits, different strategies, different TA, different setups for them. And if you can identify when a range is developing, when a trend is starting, when a trend is ending, this can help massively with profitability. Now a range can it can range up, it can range down, it can range sideways. So let's start by defining these. So to me, a range is back and forth price action, back and forth, and we'll draw them as well. A range is rarely or never more than 2 to 3 days in same direction. So we have price typically will alternate red and green days, or maybe have 1 or 2 green days and then a red day, or maybe 3 green days and a red day. Price maybe is pivoting quite often. It might pivot twice a week. Every 4 days there might be a pivot, or maybe every 3 days there might be a pivot. I'm not going to include TA in this because we're going to come back to it. But maybe in a range, price often respects a little bit lower time frame levels, like maybe 1 hour gaps, 4 hour gaps. You might find support in reverse, especially yesterday's high, yesterday's low, or a higher low from the past week. Typically respects those levels and uses those as a pivot. So range is a little bit lower time frame signals. A trend I would describe as every day price closes in the same direction as the previous day for 4, 5, 6, 7, 10 days, 14 days. So with Bitcoin in particular, I trade Bitcoin. If you were to look at the Bitcoin chart this year, there's been about 3 or 4 dramatic uptrends where 1 to 2 weeks of just green days, maybe 1 red day sprinkled in, and 25-40% rally. Then there's been really just one extended downtrend. We've had ranging downwards action a couple times. We've had ranging upward action a couple times. But again, we're seeing that we move up. In the trend, we might have a 20 to 40% rally in a week. In a range, we might move up 5 or 10% slowly over a couple weeks, a month, 6 weeks, as it's sort of ranging. So with the trend, we have same day, same direction, maybe 7+ days. We're looking at 20 to 40% moves plus, and we're looking at on a range maybe 5 to 7% pivots. It could even be less, like 3 to 7%. Prices in maybe a 7% range. So the trading is it's way different. So we're starting by defining them. So let's kind of draw what a range or a trend might be. I'm also going to add that a range typically, the market usually ranges. So the default mode is ranging. Trends rarely, and it doesn't last that long. So if we're to look at this year on Bitcoin, it maybe spent out of 6 months, less than 2 months trending, probably around a month trending. So it's tends to be ranging for 80 to 90% of the time. And for me, and maybe for you, we become range traders for this reason. If we're professional traders and we're at the charts every day, we tend to become range traders. We're not doing position trading like investing, which takes advantage of these trends. But and when we're ranging, it feels like it can last forever, right? And you can make really good money on ranging. Like you catch a couple pivots a week, and each of them's a 2-3R, maybe a 4R if you pyramid in. But these trends, if we're not prepared for them, and this is something I personally struggle with, which is ironic because my first big trade was a Bitcoin position where I held through a number of trends. I held from around 10,000 to 69,000, just held. But I struggle with these trends because I get used to what works in a range. Trend comes in, I'm trading it like it's a range, I take a couple stops, and maybe I'm able to jump in the trend later, maybe the trend, even if it's short, it's traumatic because it feels like crazy where all your setups don't work if you're a range trader, and none of your TA works, and none of your indicators work, right? It's so overbought or it's so oversold, it just keeps going higher and higher, it keeps going lower and lower, never reversing. It makes you feel crazy, and it can be quite traumatic psychologically. So I'm quite interested in, for me, this is why I'm making this video, is because I want to improve at trend following. It doesn't happen often. I don't want to be primarily a trend follower, but at least take fewer losses when the range breaks and the trend develops, and do a little bit better, hopefully, with the trend. So the range, you catch like 2R, 4R, 3R, maybe a 5R, like you get a couple of these trades a week, maybe a good week, 3-4 winners. A trend is single direction, but this is where you can get, if you pyramid, you get your 10R, your 20R, your 30R, your 50R, your 100R trades. These are real and they can really happen, because if price rallies 25% in 7 days and it never pulls back more than 2%, you can imagine if you just every day you buy, like, you don't even need to manage your risk that well. You make so much money, right? So, but identifying when to do it's a lot easier said than done, because you need to break your habits of what you do when you're trading the range 80 to 90% of the time, and get into this trend mode. So I will say Bitcoin, which is what I'm talking about, trends different than a lot of other markets. So for instance, Bitcoin spends a lot more time ranging than trending compared to, say, Forex markets, because there's a lot less fundamentals behind Bitcoin. We're going to get into fundamentals a little bit. But compared to a Forex market to Bitcoin, Forex market tends to trend a lot of the time. It will consolidate, but it's more balanced. It's closer to 50-50. It probably still ranges and consolidates more than it trends. But the trends offer pullbacks and pullback entries, and you can pull back to different strategies, order blocks, fair value gaps, or whatever. Whereas these trends with Bitcoin, it ranges. The trend is straight up, no pullback, and they're dramatic when they happen. And the possibility for money making them is insane. I've done it once before, but for the most part, I haven't done a great job. So I'm going to get a lot better. So fundamentally, what is a range? Fundamentally, a range is indecision on investors. And also, you can imagine it like an arm wrestling match between buyers and sellers is equal. And the gyrations that you can capture are typically traders getting stopped out, short-term news events, liquidation. So liquidity is the name of the game for range. Liquidity is everything. We're going to come back to this in terms of TA and how to spot when the market's changing. Oh yeah, I said I would draw it. You know, range is maybe like price is doing this, like it might move down, but only for a couple days and it reverses, right? And then finally a trend is like this, right? Like this is very different from this. Okay, so fundamentals or range is like indecision. So you're competing with other traders. So a trend is typically the public becomes involved. and makes up their mind about a direction. And so liquidations and what other traders doing becomes almost irrelevant because it's not a trader dominated market, it's an investor, a public dominated market. So you're looking at totally different indicators. And instead of you might be looking at EMAs and trend lines especially, and we're going to get into that. But a trend is typically caused by a lot of public market buying or public market selling. And also this is why uptrends and downtrends tend to be a little bit different. Uptrends, this is not always the case, but uptrends oftentimes, from my observation, can last more days than downtrends because there's always more money that can come in from the sidelines to buy. There's always more, people who are long can always get more long. But when it comes to downtrends, and also because there's a characteristic of greed where greed can last for a very long time. People can stay greedy for a long time. With downtrends, first of all, you have most of the public does not sell short. They will sell the inventory that they have. They will sell their investment. But once that's gone, they're not going to go short. So this is a reason why, from my observation, major downtrends are often quicker and shorter. And also because of the fundamental of fear. Fear is more of a fleeting emotion where you or people don't stay afraid for that long compared to greed. Like you can stay greedy longer than you can stay fearful. So that's a little bit about trends. So fundamentals, let's talk about we're going to talk about a little bit about how to trade them. We're going to talk about TA and cycle signs and strategies. So how to trade them. So for a range, we're looking to, you get rewarded for switching direction quickly, so taking profits relatively quickly. A range is more about reading signals. So that signal can be, here's some examples of signals on trading a range. It could be a retracement to a Fibonacci level. I don't do so much of that. I really like sweeps of daily highs, sweeps of daily lows. I like sweeps of daily highs, sweeps of daily lows into a fair value gap. I like to look at HY block as liquidity, and there's also crypto quant, some others where if everybody's long, I'm going to be short because those long people are going to get stopped out. They're going to have to sell. They're going to sell if price goes higher. If I'm short, if everybody's short, I want to go long. I want to be opposite the other traders. I'm looking at liquidations. If a lot of people are getting liquidated, I want to enter on reverse. If a lot of liquidity is taken from the past week, I want to enter reverse. And then I'm looking, I might have a target, a high time frame target. I don't expect it to reach that target. I'm looking for a signal that price is probably going to reverse. I'm going to get out and I'm going to switch my sells to buys and start buying and going back and forth, maybe trade 2 to 4 pivots a week, not holding a trade for more than 1 to 4 days. And that's how I like to trade the range. And the range, you get paid for having good entries. Your exits don't need to be great. You don't need a good target, but recognizing when the market's about to reverse is hugely important. So getting a good entry, an early entry, a precise entry. It's also important because since we're looking at capturing, say, 5 to 7% moves, we're just trying to get a couple percent out of the market, 4% out of the market, 6% out of the market, and not necessarily hold to a really large target. When you're trading a range, oftentimes you get punished when you're greedy. If you're greedy during a range and you're trying to hold for higher, price will come back to your entry or may stop you out. So you have to really be quick on your feet and read the signals. So it's trading a little bit lower time frame, checking in a little bit more often. So I love range trading. The market ranges most of the time. This is how I do it. And I've been doing really great range trading. But when trends come around, it's a little bit harder because it's different habits. So with the trend, trending is more about recognizing that price is driving towards a target, identifying what that target is, and getting in anywhere and holding for that target. So with a range, it's important to have a precise entry and not important to have a target. With a trend, it's important to have a target, not important to have a precise entry. So, and that's because when Bitcoin is trending, if you look at some of the more dramatic trends, where it's 7 to 12 days of straight up, sometimes over a 10-day period, it will go up 40% and never pull back more than a couple percent. That means you don't need a setup to enter. You can enter almost anywhere. You still want to run a stop, say a 2 to 3% stop. If you get stopped out, it's still trending. Maybe you get back in. So maybe you run a wider stop. You could do that too. But trending is more about just buying. So and holding, or selling and holding, right? Sitting on your hands, ignoring these short-term reversal signals. And we're going to get into TA, more about EMAs, trendline breaks, and stuff like, and monthly targets. For a range, limit orders work a lot better because a limit order only works as a reversal or a retracement. Trends on Bitcoin do not tend to retrace that much, so limit orders usually go unfilled. With a range, if you're limit ordering, market ordering, you need to be a little bit more careful about those. And trend, you can even use stop market orders. I don't like stop market orders, but it can work a little bit better for trends. So trend is all more about sitting in this position for 7 days. Maybe the only trading activity you do is pyramid, add to it, advance your stop, let it play out, hold for a monthly target, get in, market buy. So you can see how it's really different habitually if, like, for 6 weeks, all I've been doing is pivot, every couple of days pivot, every couple of days close a trade, open a new trade, and then all of a sudden we go into a mode where price looks like it should pivot, but it doesn't, and then it just keeps going and going and going and going, and trying to get in and out, like when all you had to do was buy and hold or sell and hold. It's a lot easier said than done. So what we need to do is identify when trends are happening. And for a trend, rewards greed a lot more, where having this really big target, thinking it's possible to get 10, 20, 30, 40 R is possible, and you get rewarded for that. For trending, it's also especially important to be courageous and have courage, where you're risking so much un-P&L. And you can reduce your risk by advancing your stop, but it takes courage to hold a big position for 2 weeks, right? And hold through these minor retracements and wait. So let's get into a little bit of TA and identifying when it's going to happen. So range versus trend, TA. The most important TA is liquidity, longs versus shorts. Liquidity, longs versus shorts, daily highs and lows, maybe weekly highs and lows, but daily highs and lows. What else is important for range trading? 1 hour and 4 hour fair value gaps are good. I would say these are the main tools that I use, but mostly liquidity, like heat map, or knowing where people's orders are, because I'm trading against other traders. I mean, you can use fibs and stuff, but those are the main things. So for trending, one thing that's actually quite important is exchange flow. Typically, this isn't always the case, but this is a fundamental way of spotting it, is there's an extended period of drawdown and there's lots of inventory leaving exchanges is probably a markup, because people are buying and pulling off and planning to hold for a while. And when there's a period where price is high and there's a lot of inventory coming onto exchange, it's a sign that price is going to go down, because people are preparing to sell. So that's an indicator. I would also say, what else is really important, high time frame trend lines. When I say high time frame, I mean the weekly chart, that price has touched this trend line maybe one, let's use a different one. Prices touch this trend line once, twice, 3 times, and is now breaking out or bounced off of it. High time frame trend line and high time frame EMAs. This is the 20, the 50, the 100, the 200 daily and weekly EMAs. If price reclaims one, it can be the confirmation of a trend. If price rejects or bounces off one of these high time frame trend lines, it can also be high time frame liquidity. So on a trend, ignoring low time frame liquidity, but high time frame liquidity maybe being 3 and 6 month heat maps, monthly highs and lows. Monthly highs and lows are important for trend. Like for ranging, we're looking for the trigger of, okay, we hit the key area on the heat map, a lot of traders got liquidated, shorts got stopped out, everybody's still long, we took yesterday's high and we're falling under it, we swept into a 1 hour, 4 hour fair value gap, close longs, go short, vice versa. With a trending environment, it's like, okay, price has been ranging for a period of time, stagnant down, there's a lot of inventory coming onto exchanges, there's been bad news, we are starting to, we're bouncing off a high time frame trend line, a reversal has occurred, we are moving towards EMA, we're moving towards trend line, we broke that trend line, we broke that EMA. Okay, where is the monthly target? What are these fundamental investors who stepped in? Where are they going? Where are they aiming for? So when trading a trend, and this is why it's important to identify when one is started, one, price doesn't reverse. So if you try to counter trade, you're going to lose. You're also going to miss out on the trend. Longs versus shorts doesn't matter because it's not about traders, it's about investors. So the traders can be 90% long and they're all right for weeks. Traders can be 90% short and they're all right for weeks. It's possible. Liquidity, any kind of low time frame liquidity doesn't matter. It gets blasted through, people are getting stopped out, doesn't matter. Price is driving towards a major target. Price is coming into 1 hour, 4 hour fair value gaps, doesn't matter. It's going towards a monthly target in a straight line over 7 to 12 days, right? So those are the main like TA that we're looking, and you can see in here where one would end and one might start, but part of it is just understanding that after a long trend, usually it's not a counter trend. Usually it's a long range. We have a major trend, it's probably going to be an accumulation. Sorry, it's going to be a distribution and then a pullback. Whether the pullback trend consumes the uptrend or not, doesn't matter. We could have an uptrend, accumulation, distribution, downtrend, accumulation, uptrend. Sometimes you have uptrend, sideways accumulation, another uptrend. That's more rare. I mean, a lot of the time in a real high time frame uptrend, you have a huge uptrend, sideways distribution, and then you have a retracement, which is a downtrend, and then you have the next leg up, right? Elliott wave type stuff. So just knowing that when you're in a range, this isn't going to last forever. But from liquidity, one of the main keys is when there's a huge amount of liquidation on the chart, and you can see this with HY block capital, you can also see this just from looking on your chart and seeing how much structure there is, how many highs and lows have been untapped, and there's a lot on both sides. When price comes and takes out one side and starts to reverse, it's a sign it's going to go all the way to the next side very quickly. But on liquidation, it might be maybe there's a 6-month hotspot. If that 6-month hotspot gets wiped and it's reversing, it's going to go to the next 3 to 6 month hotspot, which might be very far away and might go there very quickly and blast through all these lower time frame structures on the way there. That doesn't happen often, and it's not that it doesn't happen, it takes a long time to build up the conditions for it, for a crowd movement. And even though it is the trend tends to be more investors coming in and buying or selling inventory. It is sped up by traders who are moving in direction of the trend as well, and also their stops is jet fuel to get it going. If there's a lot of people who have been short over the past months, and price starts stopping them out, and vice versa, that is a sign that a trend may begin. Just the conditions for a trend, like if price is extremely oversold, but it's been grinding down, ranging down, range down, starts pulling back in. There's been bad news. We took the major liquidity to the lows. There's major liquidity to the highs. If we start taking out the EMAs and the trend lines, boom, conditions for a trend. Vice versa, if we go very high, but we range high, we had a trend and then we're ranging high and we're sweeping the highs, we're sweeping the lows, we've been ranging and we're building up a lot of liquidity above and below, and we come out and we take out the lows in a sharp move and start to reverse, and the next target is very high away, we could go to that target very quickly. So this is how we get those 20-40% moves in a short period of time. So now the sign that we're going from a trend back to a range would be, the first would be, what is a range? Is price driving towards a high time frame target, a monthly target typically. If price hits that monthly target, and now an exception to this, let me back up for a second, is when price is in price discovery, it's a little bit trickier. I'm not going to speak on that too much, where we're at all-time highs already. There's other things that you need to look for. I don't have that much experience with that, so I'm not going to talk about that when Bitcoin's at new all-time highs. It might be, maybe it's not a new experience for me because I traded through that, I held through that, but as a shorter-term trader, it will be sort of a new experience. Okay, back to that thought. Price turning from a trend to a range, the first sign is just that simply we hit our target, because these investors and also these traders, say we're in an uptrend, they're looking like this trend could go a long way. I'm going to sell when price hits this far off target. It hits the far off target, they sell. I'm going to buy when price hits this low target, they buy. So coming down to it, like with a range, like heat map, liquidity, longs versus shorts, sweeping high or low can be sent a reversal. For a trend, it's like typically a monthly target. It might be a weekly target, typically a monthly target that we're aiming for, a monthly high. It's going to move quickly toward take out a monthly high or low. And once we're past that monthly high or low, now, and you look at the chart, and we took the main target, and we came so far, and there's very little structure on the chart. There aren't a lot of equal highs, equal lows. This is a sign that a trend is going to start to begin, because price needs to build up liquidity, conditions for ranging, and conditions for the next reversal. This is something that I've gotten a lot better with, is thinking that we have a strong trend, we're just going to counter trend. Like we have a huge rally, it's going to retrace. Or we have a huge dump, it's going to just pump. Usually it doesn't work that way. So with the rally, for instance, you have a major uptrend, price runs up. As price goes up, it attracts the buying public, it attracts investors who want to come in and they want to start buying spot. Now you have this community of traders who have all this inventory to unload. You can see from the chart that traders are 90% longs. So it's now a battle between these traders and the investors who are coming in late and they're buying. And the traders are, they're going to sell their inventory on advances, and they might sell some inventory on dumps, so there might also be wicks down, there might be wicks up, but you can see how it starts to trend. And then it's going to get to a point where these longs have unloaded their inventory, and the buying public isn't as excited anymore because prices stopped moving, and now we're in a range. And now as the range trades, liquidity builds above, liquidity builds below, and that can create the next move down. But it doesn't happen immediately. It's very rare to have a trend up followed by a trend down. And I'm talking about a high time frame, 7 to 12 day trend. It's very rare to go, okay, up green every day for 14 days, then red every day for 14 days. With Bitcoin, it maybe like the very end of one of these dramatic bull cycles, but I mean, it takes a while to retrace. They say elevator up, stairs down, or stairs down, stairs up, elevator down. I had another thought here. Okay, on the other side is if price has a massive flush down, then typically it doesn't V reverse. And I mean, in a range it V reverses. If you have 3 sharp days hit a liquidity reverse, and reversals tend to be faster and more dramatic than tops, again because there's a lot fewer short traders. People can only sell the inventory that they have, typically, the buying and selling public. And because fear is a much faster passing emotion than greed. But price comes down in a major trend, every day is red for a really long time. It gets to a point where people want to start buying at these levels, and also shorts want to start covering at these levels. But people are so underwater that as price rises, they just want to sell and get out. As price moves back to break even, they want to sell and get out. And also late traders coming in, trend followers. So there's a balance and a battle, and then the traders become more balanced, liquidity builds up, and price can reverse or start sweeping and have a counter trend. So we have range for 6 weeks, trend for 1 to 2 weeks, range for 6 weeks, trend for 1 to 2 weeks. I love trading the ranges. I really want to get better at trading the trends. And it's hard to do because you have different TA, different strategy, different setups, different behaviors, different psychology. You're rewarded and punished for different things. But yeah, I mean, there's an alternative where the market trends, you just sit out. Or maybe if you're a trend follower, the market ranges, you sit out a lot of the time. But for me, I want to, if I can identify a trend is happening, I don't want to just sit out, I want to participate, right? If you can identify, and I believe I can do it. Range trading is a lot harder in terms of technicals. I think psychologically, trend following might be harder than range trading, because range trading, like as a human, you want to do something. I want to open and close positions. Range trading pays you to open and close position. Trend following pays you to sit and do nothing, and sit on your hands. You bought and now you're sitting and waiting. Or you sold, now you're sitting and waiting. So technically trend following is easier because there's fewer actions, there's fewer decisions. But fewer actions, fewer decisions is actually harder when it's your job to be a trader, to show up at the desk and say, I'm going to sit in my position today. So hope you found that useful. If you did, comment down below. Appreciate you, much love, and hope you found it helpful and useful. Peace.